Hey, Justin. Good. Well, while we're waiting on the social media to build our platform, today we're going to talk about paying off your mortgage in a flash. Paying it off really quick. And so while some people are hopping on, don't forget to like us on Facebook and on Instagram, and we have a YouTube channel. And Justin Singletary with Erica Holmes on both Facebook and Instagram, and then Erica Simpson on Bossed Up Academy on IG as well as on Facebook. So, Justin, tell us what we're talking about tonight.
So tonight we're talking about how to pay down your mortgage sooner, refinancing, principal payments. So we're just kind of going into maximizing your down payment.
Okay. So when we say maximize your down payment, say you get 100% financing, which is still available, no matter what people tell you, you can still get 100%. There are some banks that's requiring 20%, but not all banks. They still got some first-time buyer programs. They still have, if you don't have a mortgage currently in your name, say you sold your house, but you've been looking for a house for a few months, well, you can still qualify for some of those programs. So I would suggest that you look into those programs or call Justin or myself if you're still looking to get 100% financing. Say so you just recently sold a house and you got $50,000. Well, your payments only change $5 per thousand. So if you got $50,000, it's only going to change your payment $225 a month. So how long is it going to take you to get your $50,000 back by saving $225 a month? Well, it's too much to calculate tonight. So I don't recommend it, but you can use a different strategy. So say you get the 100% financing, you've been saving up for your down payment, but now it doesn't require down payment. Well, once you close on your loan, you can take that $50,000, and if you want to put it on the principal, then that is going to cut your number of years down because interest is accrued daily. So that means, say you just bought a $200,000 house, guess what? Don't bring it to the closing table. Wait till you close and then apply it to the principal then. And that's going to cut your years off, because if you bring it to the closing table, your term is still going to be 30 years. Versus if you wait a month and just put that large chunk on the principal, then now your interest is being calculated off of 150 instead of 200,000, which is going to put you way down the amortization schedule. And if you're not familiar with an amortization schedule is, that is when it shows the breakdown of what's going towards principal, what's going towards interest. So I would suggest, if you got a down payment, hold that down payment until after closing and put it on the principal. Don't just make a payment, because if they add some of it to the interest, it's not going to give you the leverage that you're looking for. So I would do the minimum that's required for me to get the loan. Once I've got the loan, then I would go in 30, 45 days later and put the rest on the principal. And that will cut your years down.
Gotcha. And so next, we can kind of go over the bi-weekly.
The bi-weekly payment. So if you do the bi-weekly payments, some mortgage companies charge you to set this up. So the only thing that they do is allow you to pay your mortgage twice a month. So that means you might pay on the 1st and then the 15th, or the 15th, then the 30th of the month. Well, with bi-weekly payments, the reason that you save money is because you're calculating on a lower principal amount. Example, say you owe $200,000 on your mortgage, and you now you made a bi-weekly payment. Well, $500 of your $1,000 went to the principal on your bi-weekly payment. So now they're going to calculate the interest based on $199,500 instead of $200,000 for 30 days. So bi-weekly payments help you because they're calculating it on a lower amount in between those 2 weeks. And when you talk about 30 years, it will cut your mortgage down significantly. So that is another way. Some people charge, but some you can, they'll let you do it the other way. So you just have to ask your mortgage company if it's available and what the charge is for that.
Got you. And then the principal payment is next.
Okay. The principal payment is kind of like when you work that down payment to maximize your down payment. And I tell people that you can do this a lot of times when people get their income tax. A lot of times that's when you got some extra money, or when you got your stimulus check, or if you get an extra stimulus check, if you pay one principal payment per year, then you can cut a 30-year mortgage down to 22 years. Again, because you are making you're taking yourself down the amortization schedule. That's because your principal balance is going down, and the interest that's being calculated daily, again, is being calculated on a lower amount. So I would suggest that you do the principal payment when you have a large sum of money. I don't recommend you doing a monthly principal payment because it's too much to keep up with. Say, for instance, you add $50 every month. Well, that means you got to go into your statement on your mortgage and check to make sure that they didn't apply it to interest. You got to make sure that they applied it to the principal only. Well, that's kind of cumbersome to keep doing on a monthly basis. So it's better if you can just do it once a year. You don't have to worry about doing it, and it's done. That is the reason why I say do it when you got income tax, or some people use, if it's easier for your budget to do $50 a month, then you can open a Christmas account, and Christmas accounts usually pay out in December. So if you wanted to say, oh, I'm gonna save up my principal payment, $50 a month, I would put it in a Christmas account that's gonna pay out in December. When it pays out, then you can transfer that money to your principal payment. So it's more than one way you can do the principal payment, but I just highly advise against the monthly, because if the payment is applied incorrectly, it defeats the purpose.
Right. And then the last topic would be refinance. And with refinance, I've seen like a lot of people that I put in homes, maybe 2 or 3 years later, they'll go back and refi, and that'll lower the interest rate. So refinancing is beneficial, to a person. Say you got a loan and you had a low credit score. Later on, you got your scores up, and then you went back and refi, and now you have a lower interest rate, which, actually lowers your monthly payment.
Right. And if you want to use that refinance to actually to pay it off quicker, because you can what you can do is, if you want to use a refinance, is to shorten your term and keep your payment the same. And say you go from a 30-year to a 25 or a 15-year, because you're getting a better interest rate and because you're shortening the term. So sometimes when you refinance, you can also shorten the term, which is going to actually allow you to pay the mortgage off quicker, even though it's a new loan, because now you can get a 20-year loan, a 15-year loan, a 10-year loan to cut down on the number of years, as well as giving you more leverage with the lower payment, that you can still pay the amount that you were paying before, and that will give you more leverage to actually pay it off quicker, because then you can make additional principal payments.
Right.
So, any questions? Drop us some questions. Also, if you have any topics that you would like for us to discuss, please inbox either one of us. We'll be glad to bring it as a topic so that you can have more insight. If you want to ask us a question now while we're on live that you know, thought of while we were talking, or just something that you want to know about real estate in general, then you can do that now.
Yes, and then also, like you were talking about earlier about a lot of the no money down programs, a lot of those are still available. So if you have anybody, family, friends that's looking to purchase a home, definitely, have them reach out, because I'm seeing now a lot of clients that's been with other agencies and kind of like, oh, I can't get my loan closed. Oh, I can't do this. How are y'all able to do this? So again, we still have connections with lenders that are still doing no money down programs.
Right. A lot of people are blaming COVID-19 for why they can't do a loan, but you don't have time for excuses, especially if you're trying to buy a house or you're trying to refinance a house, or now if you're trying to do a construction loan. A lot of the construction loans have been, minimized. So don't let money discourage you. We go out and we find the money, and that's why we can get more clients done. And our strategies, even after the sale, because like tonight, we're talking about how can you pay that mortgage down. It's not all about us trying to get business, but we want to make sure that the public stays informed about the real estate market, the real estate industry. We not only want you to obtain home ownership, but we want you to be able to sustain home ownership. And then eventually, if you want to upgrade, downgrade, you have the flexibility to do that. And you didn't feel like somebody just put you out here and left you.
Right.
So, let me make sure we don't have any questions before. We do have a question. Are you able to work with people outside of North Carolina? Yes, we can work with people outside of North Carolina and South Carolina. Actually, we have a government program that we are certified to do, and it's in all 50 states, and it's where the government will help pay your mortgage. It is location sensitive. They do have a United States map, but there are areas in every single state, all 50 states, and we are able to do that. And on the deals that we don't on hand work with, then we have partners in other states that we built relationships with that we can connect you to get you what you need. So please do, Latrice, reach out to me on the inbox, text me or call me, and let's have a further discussion about this. I've got another question here. What was the very first tip before the bi-weekly one? That one was maximizing your down payment. We were talking about, and I'm just going to go briefly on it over because I see some people that may not have been on here earlier, but can benefit from the information, that if you're buying a house and it doesn't require a down payment, but you want to cut down your number of years and you save money to do that, then we would suggest that you do it after the closing So that way you can apply it to the principal and it cut down your number of years to bring you down your amortization schedule. So that way it doesn't keep you at the same number of years, but actually bring your number of years down by waiting to make that principal payment. Any other questions? Those are some good questions. So we got people that's outside of North Carolina and South Carolina checking us out. That's a good thing.
And I got a text from somebody. They wanted to know, is it better to get a mortgage loan with a low credit score and then refi in the next 10 years to shorten the term of the actual mortgage?
Okay. Well, that's not a cut and dry answer. The reason being is because it depends on what type of loan did you get. A lot of your FHA loans, some of your government-backed loans that make home ownership a dream for most people. It depends on what the rate is. You could, if you got a mortgage, say 8 years ago, your rate, even if you had a 700 credit score, could have been at 6.5. Even now with bad credit, you can get a 3.5. So it's not to your advantage to refinance just because your credit score improved, because because interest rates change on a daily basis. And it depends on what's going on in the world, the economy, that decides what the rates are. And right now, they need to keep the rates down low so that people will aggressively buy so that we can keep the economy strong. So I would suggest that before you refinance, we offer this as a free service to anybody to contact us and let us know what you currently have and what you're looking to do, and we can give you a free analyzation of that. Because remember, the person that's calling you to refinance, they're going to tell you no money out of pocket. Well, they're going to roll it into your loan and eat up your equity, but you want to make sure that it's going to benefit you and not help them just get another loan to get paid off of. So I hope that answered your question. But like I said, it's not a cut and dry answer. Just because you have to look at what the rates are at this time, just because your credit score improved doesn't mean that it's a great opportunity to refinance, because it all depends on what the rates were at the time that you purchased. Any other questions? Bring them. Well, if you since we don't have any more questions now, if you want to create a watch party, please do share and like our video. Create a watch party, because you may not benefit from the information, but somebody on your wall or your timeline is looking for some solutions to some problems that they may be having or going through, and you could be their answer to just what they need. So I would encourage you to create a watch party, tag some people. Thank you, Eureka. I saw where you tagged a few people in the video. So I would encourage people to help us disseminate this information. And like we bring every week, on Wednesday night, we're going to be bringing you more and more information. We want people to stay encouraged, stay healthy during COVID-19, so that you can continue to progress, and that things are not and will not be as bad as they seem. And our theme during COVID-19 is, in difficulty lies opportunity. You just got to go out here and find out where the opportunities are and take full advantage of them. Anything else you want to add, Justin?
Nope, that is it. We'll see y'all, I guess, next Wednesday.
All right. Thank you.